Buenas tardes, estás en el set porque vas a seguir analizando también el mercado. Tenemos una entrevista ahora, te cedo a ti el testigo y vamos a ver también algunas de esas claves que ya hemos comentado.
Efectivamente, vamos a adentrarnos un poquito más, Carlota, en el contexto de los mercados financieros y lo vamos a hacer saludando en los próximos minutos a Jan Vormoor, Senior Investment Specialist en First Eagle Investments Amundi International. Jan, thank you so much for being here. Good morning.
Good morning. Buenos días.
First of all, I wanted to ask you about the current situation of the market. What are First Eagle's views on the current situation?
Yes, so it's a very interesting market environment, very challenging, very volatile, and to a certain degree, as long-term investors, we believe that we are seeing probably the beginning of a paradigm shift here. You know, after a decade of ever decreasing yields, of low inflation, of rising valuation, and a strong equity market supported by central banks, we're really seeing a reversal trend now. That many believe is maybe more cyclical in nature, but fundamentally we see at First Eagle the chances for a more structural shift in the markets where inflation might stay high for quite some time, where stagflationary risks are occurring and might happen, where geopolitical environment is very complex and might remain very complex for quite some time, which is of course more of a headwind for financial markets and risky assets, and where it's going to be very important to find solutions that not just serve on the market beta, but that are able to generate alpha in a structurally more challenging market environment.
Speaking of inflation and interest rates, today we have the decision of the FOMC meeting, the Federal Reserve. Do you think the Fed is going to rate hikes exactly on 50 basis points instead of 75, which is what some people are thinking?
Look, I don't know. We have some contacts at the Fed, but I don't have any idea what they're going to decide. It's a very tricky path for them. It's very uncharted territory, and they have to balance between, on one side, inflationary pressures that are much more persistent than they initially thought, and on the other side, they want to maintain the growth path of the US economy, which is still doing relatively well despite the environment we're in today. So we'll see. But at the end of the day, 50 or 75 is not that important. It might trigger some volatility on the upside or downside, depending on market expectations in the next few days. I think as a long-term investor, it's more important to take a step back and try to reflect on how this evolution in the market is going to evolve in the coming months and years. And for that point of view, the decision that was going to come today is not necessarily that important.
I wanted to ask you about First Eagle Amundi International Fund. It has a trajectory of over 25 years of value investing. Can you tell us a little bit more, Jan, of your philosophy behind this fund?
Yes, of course. So at First Eagle, we are value investors, but we are value investors from a philosophical perspective, not from a style-based perspective. For us, it's not about finding statistically cheap companies. It's really about finding great businesses, independent from where they're located, if they're big, small, whatever industry. If they're considered growth or value, we don't really care. What we care about is finding a really good business that has high margins, high entry barriers, that's able to protect its business against external shocks, that has very captive clients, that's very well managed, that's a good balance sheet, and that we can buy at a discount to its economic value, to its intrinsic value, with a margin of safety. So that's for us what value is about. And we seek to have these companies as a core of our portfolio over the very long term. We are very long-term investors. We see ourselves as business owners, not as stock traders. When we can find such opportunities, we're so happy to bring in a portfolio and hold them for sometimes 10, 15, 20 years, sometimes shorter, of course. If not, we'll be happy to keep some cash on the sideline to be able to use pockets of volatility like what we could witness in the coming days, depending on the Fed's decision, to take advantage of short-term volatility for finding great opportunities at discount valuations for the long term. And then we also have a strategic allocation towards gold-related securities that we view as a potential hedge against more systemic events, and that has helped quite a bit so far this year. Plus also as a kind of deferred purchasing power like cash over the more long term but with an inflationary hedge as well. So that's how we structure a portfolio with a very simple goal. Our objective is not to beat a benchmark or something like that, is to at least preserve the purchasing power of wealth over the long term by generating very attractive absolute returns and very stable absolute returns over the long term, independently of the market environment around us.
You told us about your gold position. I'm going to ask you about that later on. But first, with this philosophy that you told us, what kind of companies do you look for in your portfolio and how long do you hold them?
So at the heart of what makes, in our mind, a really good business is some element of scarcity. And it's either companies that own very scarce real assets. These can be, for example, real estate businesses. I was in New York last week, and if you own a building that's on Fifth Avenue with a view on the Central Park, that's an asset that's scarce. There are not many houses like that, and it's impossible to duplicate. You can't just build a new one. There is no space. And as such, this asset is very inflationary protected, has a very high value, and over the long term, its value, because it's limited in supply, but there's structurally growing demand, the value is increasing much faster than inflation or economic growth, and it can grow the purchasing power of wealth. So it can be real estate, it can be precious metals, it can be energy, it can be forests. There are many different types of assets that have this similar supply-constrained nature that we think is structurally very interesting. But it also can be businesses that have scarce intangible assets, assets that allow them to have monopolistic or oligopolistic situations with very high entry barriers, with very captive client, and this client captivity, even by choice or because they don't have a choice, makes that these clients end up having a relatively limited price sensitivity. In other words, these companies have pricing power and have the ability to navigate more inflationary environments relatively well and to continue to produce attractive return on equity and shareholder value in such more challenging environments. And here it can be, again, a lot of different companies. It can be growth companies, it can be more traditional companies from the luxury space, from industrial space, Japanese, US, but it all comes to the same idea. They own very scarce assets that are very difficult to duplicate, and they create some kind of a moat of sustainable competitive advantage and providing them with superior potential returns over the long term, even in challenging market environments.
You said, Jan, you have a structural position on gold. What are the reasons for having gold, and what are your views on this precious metal?
Yeah, as I mentioned in my earlier comment, our primary objective is to at least protect the purchasing power of wealth, which means that our main enemy is losing money. And when I say losing money, it's not short-term volatility, it's the risk of permanent capital loss over the long term. And as such, we seek to build a portfolio that seeks to minimize that risk. This is why we only buy at discount valuations with a margin of safety that allows us to minimize the risk, the idiosyncratic risk of losing money with each individual position. This is why we have a very broad, diversified portfolio with over 130 positions and never really more than 3% exposure to one single holding to diversify the idiosyncratic risk. But then as a third layer, we have this strategic allocation to gold, because gold is a relatively good hedge against more systemic events that are out there. We saw with COVID, we saw it with the war in Ukraine. Every time you have, or in 2008, 2009, during the global financial crisis, every time you have such a systemic event, gold tends to behave quite well because it has very specific attributes that decorrelates it or even negatively correlates it to confidence. And therefore acts quite well as a potential hedge against more systemic events for an equity-oriented portfolio.
Vormoor, Senior Investment Specialist at First Eagle Investments Amundi International. Thank you so much for giving us your views. Thank you.
Muchas gracias. Hasta luego.
Gracias, Marta Vilar, por esa revista con